These are 5 things that always happen before a stock market crash. But I need you to promise me something first, and that is you'll stick around at least to number 4 because it's critical. Okay, let's jump in. The first one is it always feels safe before the crash. In fact, oftentimes it's never felt safer to be in the stock market. You look at the returns over the last 4, 5, 7, 10 years, whatever the period is, and you're like, gee, you know what? I'd be happy with even the worst of these years. My risk tolerance is fine. I'm okay with the worst out of those 10 years or even half of that. So it feels really comfortable. Number 2 is everybody is talking about the stock market. Think about Bitcoin in 2016, 2017, when the price was skyrocketing, and everywhere you went, people were talking about and frankly bragging about the initial price that they paid for their Bitcoin. You couldn't get into an Uber or a Lyft without the driver talking to you about Bitcoin. So it feels comfortable. Everybody's talking about it. You feel cozy in the center of a herd. And oftentimes being outside of the herd, it feels cold. It feels lonely. It actually feels riskier to be outside of the herd. Okay, let's keep going and talk about the next one here. Number 3, the market starts going down. And as the market goes down, maybe a little voice in the back of your head is saying, buy the dip, buy the dip. It's going to come right back. It always has for the last 5 years, 7 years, 10 years. Buy the dip. Don't chicken out now. And other people are saying that. But let me tell you a secret, having been a financial advisor for over 20 years. Everybody's a hero until the stock market's down 20%, 25%, or 30%. Somewhere in there, we lose all the heroes. Somewhere in there, the buy the dip screaming begins to quiet down. And you're beginning to think, could this be a crash? At some point, people start capitulating. People are thinking, let's say you started with $100,000 and your money's tripled. So now you got $300,000. And let's say the market's down 33%. You just lost $100,000. And it's just human nature to think, how long did it take me to save that first $100,000? I can tell you how long it takes the average person to save $100,000. Even if you can save $10,000 a year, even if you can get 7% a year on that money, year after year after year, which is not how the stock market works, it's going to take about 8 years for you to save that first $100,000. And it's really hard for people to keep saving year after year after year. So it's not unusual for the answer to that to be a decade or longer it took to make up what you might have just lost in 2, 3, 4, or 5 weeks. So all of a sudden that little voice in the back of your head, instead of saying, buy the dip, says, get out now and we'll get back in when things get lower. That becomes the new mantra. Sell now and get back in when things are lower. And that's when people start capitulating. I mentioned that number 4 is the most important of this entire list. So what is number 4? Number 4 for what always happens is nothing. There is nothing that always happens. If there was a signal that you could get out before the market crash, then everybody would do that. Every market crash is unique and different in its own way. And that's what makes all of this so difficult. And people think, there's always this signal, I'll get out, I'll ride the wave, and I will get out later. And maybe you will, and maybe you won't. But the truth is, and this is why I needed you to promise me that you'd wait till number 4, what always happens before a stock market crashes, there's several things that oftentimes happen. There's several things that are correlated with the stock market crash. For instance, increase in unemployment is correlated with a stock market crash. But every time unemployment goes up, it doesn't signal a stock market crash. So unfortunately, there is no signal to get out. And that leads me to number 5. And number 5 is, given that there is nothing that always happens, given that there is no sign saying the market's about to crash, now it's time to get out. And likewise, there is no all clear sign when things are at the bottom. In fact, my point number one in this video was everybody is ecstatic. It's optimistic. It feels low risk because the stock market has done well. At the bottom is usually where it feels the scariest, where everybody else is panicking and saying you'd be a fool to stay in. It's going to go lower. So it feels the scariest, and the news is the worst as things start to bottom out. One sign that things have bottomed out is there's really bad news that comes out and the stock market does not continue to go down. It just kind of stays in the same general range. What that says is the people that are going to sell likely have already sold. It's called capitulation. It's called the public has capitulated. And the people that are in have made it this far, and you know what? They're in it for the long haul. Those are the believers in come up with a long-term strategy and stick with it for the long term. Those are the people that looked at fundamentals of companies and said, eventually the price is going to come back because the company is just too strong. Its revenues are too solid. The management team is just too good. It's got a great balance sheet. And eventually the stock market price will reflect the fundamentals. And that's why really bad news can come out and it's like, wow, the market should be down on this, and it doesn't go down. That doesn't always work, but most of the time it gives you a sign that you're in that bottoming process. It doesn't mean that things can't go worse. Okay, so what should we do instead? What we should do instead is have a long-term strategy and stick with it. If you're an institutional investor, a professional investor, you're likely not watching this video. What institutional and professional managers should do is something else. It's what their company has trained them to do, whatever that strategy is, and they're likely pretty good at sticking with that strategy. And likewise, what should we as retail investors do? Have our own strategy, our own long-term strategy that is not based on our emotions. It's not based on our fears, but it's based on what our goals are and what's the best way to achieve our goals. And that's why I think it's important to work with a fiduciary financial advisor, somebody that has been through these cycles many times, somebody that has helped hundreds of families through that. That is the gold standard. I know many people watching this video, many people in my audience prefer to do it yourself. And if that's you, to come up with a financial plan, to come up with a retirement plan, what I urge you to do is to not use Google Sheets, to not use Excel. Frankly, it just takes a ton of time to do that. And it's just too easy to make a mistake. What I encourage people to use is software that's designed for people like you and I to build our own financial plans. Again, gold standard is to work with a financial advisor, but if you want to do it yourself, use software designed to do it yourself. The software that I like is this software here. It's called Bolden. It used to be called New Retirement. If you use this QR code, if you use the link in the description, I am an affiliate and you'll be supporting the channel. So come up with a long-term strategy, your asset allocation, what percent of your portfolio is in stocks, what percent's in bonds. You want to modify that as life happens, but not necessarily as the stock market happens. And remember that volatility is a feature, the ups and downs is a feature of the stock market, not a bug. If you enjoyed this video, the YouTube algorithm says this is the next video of mine specifically for you that you should watch next. Thanks for watching this one. I'll see you in the next video. Bye-bye.